Good afternoon. My name is Dustin Dupas, Chief Operating Officer at Tabs Analytics. Welcome to our August webinar, Awful Analytics, 10 Metrics Hurting the CPG Industry and How to Fix It. We'll be reviewing specific metrics that aren't just ineffective, but also counterproductive to a company's growth aspirations. We'll also be covering the right metrics to look at instead. Our next webinar will be the 5th annual Food and Beverage Consumables webinar, where we'll deep dive into 18 different food and beverage categories, including a detailed analysis of the online grocery in both US and the UK. Be sure to join us for that on Wednesday, September the 13th at 2 p.m. Eastern Time. You can check back at the website, tabsanalytics.com, next week for that sign up. Presenting today is Dr. Kurt Jetta, CEO and founder of Tabs Analytics. At the end of the presentation, we will open the floor to questions that you could submit via the chat box on the GoToWebinar screen. Also, I want to remind everyone that we do make these presentations available to those that attended, and we will usually post this video at our webinars site, webinars.tabsanalytics.com, usually no later than the next day. So with that, I'll turn it over to Dr. Jetta.
Thank you, Dustin, and thanks all for attending this webinar. And boom, let's get right into it. Pulling a Colin McGregor, no dancing around, no methodology. Let's just talk about awful analytics. First of all, market share change. So why are we even having this discussion is because our category, our industry is in historical lull. It's been well below 2% for the last few years. The weakness is particularly pronounced with major CPG manufacturers, and they're the ones spending the most money on all the analytics. And I would contend a big part of why they're not able to succeed in the marketplace and pick up shares, they're using the wrong analysis. And one of the things that they shouldn't be looking at is market share change. They should be looking at absolute growth. So let me tell you why market share change is bad. First of all, it basically embeds and institutionalizes a flat earth perspective, meaning my gain has to come at someone else's expense and vice versa. There's no way to grow a category. It's just pushing jello around the plate. And so we take all of these counterproductive actions to quote, grow share rather than grow sales, meaning we have these cynical line extensions and a lot of price matching and all types of things that don't really grow sales. Perhaps even a bigger thing when it comes to a lot of people listening out there is it's hitting you in your checkbook, meaning I know a lot of companies that they pay people, particularly brand managers, on share and their ability to move share. Well, your share is contingent on a lot of things out of your control, meaning what does the competition do? Maybe you've grown your business by 5 or 6%, which is way above historical levels, but if some major new innovation comes and kind of pushes the industry even up to 10%, yeah, you've lost share, but you've grown sales. You've made the shareholders of your company better for it and richer. And that's the objective of the company, not to, quote, grow share. One of the things as we look at the analytics of it is share change isn't scaled to share differences. So losing a half of a share point for a 3-share brand is much different than a 30-share brand losing that half of a share point. Big thing when you're talking to retailers is talking about share up, share down, et cetera, is the category definition. A good example is we were doing something in the deodorant category where, because it was a retailer-facing analysis, we defined the category the way the retailer defined it, and that meant excluding all of the holiday packs. That tended to be that was bought by a whole different department. Well, the inclusion versus exclusion changed the category definition, and it changed the whole landscape of who or what, which brands were gaining and losing share. Our client was actually gaining share in the everyday business, but because they didn't have a strong holiday program, they lost proportionally sales. So did they lose share, or they just maybe had an opportunity cost because they were growing their everyday sales quite nicely? And then one of the things I find really offensive nowadays, and this is just a very new, you know, concept, is this misguided allure of the basis point pretentiousness. What did we get in, infused with a bunch of bond traders from Goldman Sachs or something? I mean, what is a basis point? I mean, for those that you haven't even really heard it yet, or don't really have, wisely not embraced this foolishness, it's basically one basis point is 1/100th of a share points. Meaning, so if I go from 20.00 to 20.01 market share, that's one basis point. So let's say the wrong way to do it. And to my eternal shame, this is actually a report that we were required to create for one of our clients. And so we are actively working to fix this, but in the meantime, it provides a good example of why it's bad analytics. It's awful analytics. So what we're looking at is not only a bunch of decimals and percentages and columns, but we're looking at 12-week share, the change versus prior period, change versus year ago, same thing for 24 weeks, and then 52 weeks is just versus year ago. So you can see a lot of these shares for one decimal, all of a sudden, ooh, we're carrying out to 2 decimals. So can I give you some perspective? So again, this 0.34, if that was 0.33 gain, the difference in those two numbers for every $1 billion of sales is 10 grand. So that's not even statistically meaningful. So why are you even talking about your business on the basis of basis points? But the more meaningful topic we're going to look at is, here's this 0.5 share gain. We have another brand 5 that gained 0.23, another brand that lost 0.23. So one brand gained, the other brand lost, and of course in the flat earth world, one came at the expense of others. At the other. But let me focus on 3 brands, 1, 5, and 8, that are going to be my benchmark competitors. And that's so you don't get into category definition issues. Identify who your benchmark competitors are. All you want to understand is, am I losing opportunities in the market that other people are taking advantage of? Ultimately, you need to be growing your business, growing your profits, not gaining share. And we're going to focus on actual growth first of all, and then relative growth next of all. So am I growing? Yes, no, and I'm growing relative to my benchmark competitors. So here's what that would look like on those 3 competitors. So you can see that there's a pretty big difference, even though they're all less than 10. I mean, this 9 is twice as big as brand 8 and 4.5 times as big as brand 5. Here's the share change. So that's all the information we just looked at. But here's what the actual sales change was. So brand 1 and 5, real solid growth. When the category was growing 3%, they grew 9 and 16 respectively. Brand 8 wasn't down all that much. They were only down 0.2%. But on a relative basis, brand 1 grew 6 points. Brand 5 really had the best growth, even though their share 0.23 wasn't bigger than brand 1. Their relative growth was much larger. And brand 8 had a modest decline, but relative to the category, that tended to amplify that a bit, and their relative growth index was a 95. So that is the better way to understand your sales trends. Consistent with our overall philosophy, though, we tend not to look at sales and share in isolation. We look at it on a sales and we have something called distribution-based analytics, but working with this awful analysis, sales per million ACV, isn't the way to do that. And here's why that's bad. First of all, it's non-intuitive. If I ask you how many millions of dollars of ACV there was at Meyer, would anybody have any clue? Is it 50 million? Is it 3 billion? Is it, I don't know. And what's $1 million of ACV even worth? So there's not fundamentally an intuitive basis for that measure. One of the real benefits of the better measure that we'll talk about, sales per point of distribution, is you can use it to project your sales for distribution gaps that you don't currently have. Well, you can't really use this because you don't have a context for what $1 million of ACV even means. Also, when we talk about aggregated product groups, a lot of people I see the use, well, my brand has more sales per million than the other brand. And in many instances, that brand that's crowing about it has, 60 or 70 items on the shelf, and they're comparing to brands that have 3 or 4. So they haven't even scaled it for the number of items. So that's flawed. So it's kind of, there's really the only value, and all of these measures I'll show you at times within the proper context have value. Some have lots of value. Sales per million ACV can be used sometimes to compare across retailer. But that is so seldom used or necessary in the context of business analytics in our industry that essentially means it's useless. And then also you get a directionally identical result as dollars per point of distribution. So why not use that number that's more intuitive? So let's again look at an example. This is an abomination of a report. This is a report sold by a retailer through a syndicated data vendor. So you're paying over and above for this mess. And so I'll point out why it's flawed. So sales per million ACV we see is this average weekly dollar sales per million ACV. So I have this item that's 0.83, so that's 83 cents per million of ACV. I don't know exactly what that means. I don't know how many. So I have 35 points of distribution, but that doesn't really show me millions of dollars of ACV I have. So again, I don't have a context to really help me project out from this number directly. I can project out from this dollars per point, assuming this is accurate, and we're going to get to that in a few other slides. But I can at least use these numbers and notice how they're directionally similar. So how's the right way? When you're looking at a single item, you do sales per point of distribution. When you do multiple items, you're doing sales per equivalized SKU or sales per ACV weighted SKU. Or you use a sales productivity index. So one has a productivity index of 130, the other has an index of 100. That means an item's doing 30% better. I'm not going to get into it because this really requires quite a bit of discussion, and I've discussed this topic in detail in 2 prior webinars, and Dustin had given you the information earlier on how to access them. So we talk about new business metrics, part 1 and 3, where we talk about productivity and ACV weighted SKUs and distribution-based analytics in general. And why I'll spend a lot of time, in fact, in this webinar on distribution, it's the most important variable in the marketing mix. It's more important than pricing, more important than promotion, advertising, anything. And that's not just me saying that. Look at any academic journal, goes to rough read reviews, and all the journals talk about distribution being the most important. This crazy concept, I tell you, that you actually have to be on the shelf to have an opportunity to sell to somebody. And then a related measure, average weekly ACV. And why that's bad is it's understated. In fact, it's wildly understated for HBC, particularly in the drug channel. Remember when Eckerd was around, I did an analysis of their vitamin category and found that 80% of their items, 80% of their vitamin items did not sell a piece per store, not per week, per quarter. So if I'm using an average weekly ACV, I'm going to look, the average item is going to have what, like 6% distribution or something like that. I mean, something ridiculously low. We even find that measure to be understated for many food items, because not only there are weak food products out there, but there's really weak stores. You have a chain, that, even a strong chain, let's take Walmart, let's take Target, or a good food retailer. The difference between the top 20% of the stores and the bottom 20% of the stores is usually about 3 to 1 in terms of velocity on a per item basis. So you can have weak stores that just don't move a piece per store per week. So you are on many, if not most items. And so when you're understating your distribution, you're overstating your velocity. And when you overstate your velocity, you don't really know what products consumers prefer. And it's really these velocity-based metrics that are the key to understanding consumer preference. We're going back to that awful analysis I just showed you, but now we're keying on another awful metric in here, percent store selling. Now there's two reasons why this is bad. So we're mixing up concepts. First of all, this is a raw percent of store selling. It's not weighted by the ACV, or each store is important. So, but then we take these velocity-based metrics that do include ACV. So that's one. But look at these numbers. Here's this item here that's one of the top items in the category, and there's hundreds of items in this category. It's all the items in their store within a store section. 11% of the stores are selling? Doubt it. But it's showing, because that's so low, that's showing the velocity as being the highest. Most likely what's happening, and I checked the pricing, is this is very high priced item. It's $50. So it's not moving a piece per store per week in 90% of the stores, but it is, when it does sell, very productive because the dollars are so high. So the right way to do it is, I'm just going to assume everything is equivalent to the total chain, 84%, and I get a much different view of velocity. So I see this top Nature's Way item is by far the best item in the category versus all of these others, and they go, in order. So the right way to do it, so Nielsen has this measure in their AOD, Answers on Demand service, called ACV Reach. That's the best. That's best in class ACV measurement. And that basically, dynamically, you can identify what period of time is going to be used to determine if a product sells, because that's how scanner data needs to be tracked for distribution. If it moves a piece in a given period of time, it's counted in distribution. But very good ways to do it. So IRI syndicated service has 13-week ACV. So I need to move a piece in a 13-week period. But I gave you that example where in some really slow-moving stores, and in cosmetics and the drug industry, even that's not going to be fully adequate, but it is very good for the majority of categories. A good measure in high velocity categories is to use a max ACV over a 12-week period. And that most certainly will pick up, particularly if you promote, and that tends to jump up the distribution levels. Serviceable, meaning in a low velocity categories, using max 4-week. Again, you'll get a better measure if you assume that there's promotional activity on a fairly regular basis. And so you may have an item that has 30, 40, and then all of a sudden bounce up to 80 because it did a promotion that got velocity going in a larger part of the stores. And then kind of as a last resort, and you really have to do this with account POSs, percent store selling. The problem being, as I mentioned earlier, there's just such a disparity in the rate of sale for a store within a chain. So for slower moving chains, like even the drug stores, I think the difference is like a 10-to-1 gap. So the best 10% of the stores generate 10 times more sales per item than the bottom 10% of the store. So all stores are not created equal, and so that's why it's very potentially problematic to use that measure. So we're going back to the share and the sales basis. So kind of the mail it in lazy man's approach, just look at 52-week sales change. Well, that's bad. You don't want to do that. And why not? Well, 52 weeks isn't reflective of recent history, and recent history is the best data to use for prediction. And it doesn't even really explain much in 52 weeks. So much can happen that alters the landscape that's not a good way to rest solely on that. Are there reasons you would want to use it for seasonal categories, sun care, for example, or allergy? Yes, perhaps, although I would even argue a better way is in season and out of season, but that's a whole different discussion. One thing you really lose is the impact of innovation. So you could have something that has only 10 weeks of sales and might be a blockbuster item, but it just gets washed out when you're looking at a 52-week basis. And also, it's particularly bad for products in year 2 of their life cycle. So if I'm in, say, month 19, I have 12 full weeks of sales, and I'm comparing it to 12 full months of sales, and I'm comparing it to 7 months. Well, by definition, I'm a hero in that comparison. So you always need to be aware of that. So here's the wrong way, just kind of some galumpa, just looking at my 52 weeks of sales, percent change year over year, and this is the yogurt category. And so I can see kind of general, ooh, Noosa's up 42%. But here's then a better way to look at that. And so what we're doing is, so this is a momentum chart. So I'm looking at 52, 24, 12, and 4 weeks. So I want to, first of all, put the 52 weeks in context, where then it becomes very helpful on, is my sales trending the right way? So you see Noosa here kind of trending down, although still very strong in recent periods. You see Chobani actually trending up, but even that's incomplete. So what I'm going to do is now take it one step further and drill down, and this is from our Tabs Insight deliverable. So where I can look at Chobani here, for example, and I'm going to click on that because I want to understand why it's growing. So not only the what, but the why, and can I get to easily the why? So sales are a function of growth in distribution, pricing, or velocity, units per SKU. So by definition, by construction, it's one of those three, or a combination of those three. But what you can see from Chobani is their growth is entirely driven by distribution, and in fact, they're gaining way more distribution than they are sales. So it's highly dilutive to the remainder of their line. You can see that minus 10%. This is the number that's most predictive of future sales, not this number. And so that's why, again, you'll use 52-week sales. I mean, it's just not telling me anything that I need for prediction or understanding. If I look at Noosa, they're also growing strongly, and it's also distribution gains. But what's particularly noteworthy is they're not diluting their business out. I mean, these are really huge distribution gains, but they're not, in this particular outlet, not seeing much of a dilution in their business. So that's actually a very good news story. That said, once they anniversary this distribution, they're going to be looking at a business that will be down slightly. But I mean, that still looks to be a pretty healthy business based on the way that there's a high degree of incrementality to their business when they add distribution. So that is kind of how the better way to take that whole 52-week sales change, and I can link it right very quickly to a first level analysis of why my sales are up or down. And then I can drill even further with other metrics that we've talked about in other webinars on why my velocity is down so much, etc. A lot of people love to look at display. Salesmen that's all they care about, it seems like, is display, because they jam more inventory with the retailer and make their bonus. So they kind of sandbag the whole year, and in December, oh my God, they're just selling display after display, but then, they have to get paid on display, but as measured through scan data, well, then they don't like displays too much, and they don't. So why is display a bad measure? Well, first of all, it's based on a very small sample, so it's rarely accurate. And in my estimation, this is really just based on experience. It appears that they underreport actual levels. And any sales guys, I know everybody's on mute, but I think I just heard a hallelujah brother out there from all the sales guys that have gotten shortchanged on their bonus because it was paid on the ACV display numbers that you get through Nielsen or IRI. Those numbers tend to be underreported, and I'm going to show you some examples of that. Also, this is not great at capturing quality of displays. I've had talked to people that say there is some kind of metric that does that, but in most databases I've seen that measure is not available. So there's a big difference between a display that hits you in the face as soon as you go in the store and something that's buried way in the back. Overall, this display is overrated, and I'm not going to litigate that case right now, but I've analyzed enough of these things to know that it's just the exception versus the rule where display on its own has a material impact on sales. That said, there are certain retailers where it does seem to do better, but again, there's better ways to move your business than just being so singularly focused on displays, which a lot of people are. But it is important to note, and again, as I mentioned earlier, all of these measures, I guess all of them, have some role, some value. It's just the way that they're used more often is the real problem, what makes them awful analytics. And in displays, it seems to have directional accuracy for the most part, and can be used and can be valuable to understand, what are the drivers of sales. Here's an example. Looking at sun care, I'm looking at weekly sales. You can clearly see the peak season right here. And then the red bars are displays. So peak display, I'm throwing out this seems to be a statistical aberration, so I'm going to throw that out. But first, a couple things here. Peak display level for sun care in a major geo is only measured at 40, and I can flat out guarantee you that that number's twice that much. There was not a store you could go to, and sun care inherently is always on display. I mean, that's the only place it has to be on the shelf practically. So this is only showing 40, but that's the peak season, which is suspect also because these displays tend to stay up the entire season. And here you're seeing the kind of a curve almost going the same way as the actual sales curve. But if I look at peak season, the actual peak of the season, it actually shows displays down. So does that mean displays not working? If I reduce my display, I increase my sales? Well, actually, what the recommendation I would have is to transform those display ACV numbers into indicator variables or class variables. Usually all have a 0 or 1. 0 if it's less than 30, 1 if it's higher than 30. And it's just 30 seems to be the number that seems, it's infrequent enough that it becomes statistically meaningful when you see it. You could also do, maybe I want to do 0, class 1 is 20, 0 to 20, class 2 is 20 to 40, class 3 is 40 plus, whatever you want to do. The point being is that there is not any material statistically significant difference between a measure that's showing you 44% ACV with display and 32% ACV with display. What you know is you had a meaningful, important, high level of display during that particular period. And whatever you do, don't compensate salespeople based on this measure because, again, these minor directional shifts really don't have any statistical meaning. Baseline. Here's one that I've had spent a lot of time talking about. So the baseline in all the syndicated services, Spins, Nielsen, IRI, they try to create a measure, an estimate of what would sales have been if I hadn't promoted. So why is that bad? I mean, it's a good idea. Well, first of all, you see consistently this correlation with promotional activity. So you see what we call the phantom spike. So baseline spikes up concurrent with a promotional activity, which is theoretically and intuitively impossible. I can't magically all of a sudden say my normal unpromoted sales would jump up. Also, you tend to see this level of excess volatility. It's kind of this squiggly line when in baseline, again, should be a steady state, meaning in the absence of any other shock, it should be pretty much consistent week to week. I shouldn't see ups and downs. We also see often where there's a bad fit during non-promo weeks. That's really how you test the how well the model fits, is that what we know to be true, and that is during non-promotional weeks. Is the baseline close to the actual? And sometimes maybe overall the average is good, but we call it structural bias, meaning you'll see weeks where it's consistently below, and then it'll shift to weeks where it's consistently over. So we want the error, the variance, to be evenly distributed. So here's a wrong way. This is a live example. This was a pasta sauce promotion at a high-low retailer. You can see these very visually. You can see these spikes did almost the same amount of volume. Couple things here. You see structurally how the baseline's consistently below even though there's no promotion. So that's that bad fit. You could track it up either to the bad fit or the structural bias. It looks to be just bad fit. Then you see these phantom spikes. So all of a sudden, ooh, mysteriously it jumps, by osmosis or something. And again, that's impossible. But you have two different executions. So the 2 for $5 would be cheaper to execute than the $1.88, but it's saying in this analysis that the $1.88 lifts more. Well, in actuality, they both lifted the same, almost identical actually, 7.2 weeks, which they have some, given that this is a fairly high cost retailer, that has some pretty big budget implications. If I ran 2 for $5, I could probably save up enough cash in my accrual to run a couple more of these events versus having to spend it all on $1.88 and not get any incremental revenue. So this is a very simplistic, quote, right way, and so this is kind of mocked up. This is not, but so the Tabs AccuBase, we create our own. This is not from that. But just, I mean, if in the absence of anything, I should see a baseline that's, you know, pretty consistent, 50,000 a week. And here's one, again, I've mocked up, but you can see these phantom spikes. And really what this is to show is if I'm trying to predict and plan out my events, you can see how much difference. So the real event does 8 weeks of business versus 5.7 through the flawed baseline. So it really does have major material impact on getting your baseline right. Average items per store, you see that a lot, you know, when people do try and do distribution-based analytics. Well, it has the wrong denominator. So this is a regular measure in your syndicated data. Wrong denominator. You don't. It's not aligned with sales and share. You look at your sales and your share across the entire geography, but then all of a sudden your average items per store is only in the stores where you actually have distribution. And again, a bad velocity measure when you have bad distribution number. So here's an example. Just focus on the average items methodology. 3 products, different sales, different distribution levels. And if I say this is a brand that's in 65% of the ACV, if I'm adding up all the distribution points here, I have 170. So 170 divided by 65 is 2.6. And you can see that sales per SKU is very low. It's almost as low as the weakest selling item. So the right way to do that is use the ACV of 100%. That's where my potential is. I'm looking at my total sales for the chain divided by total distribution potential. And so my SKU count is actually only 1.7. Within the stores I have distribution, it's 2.62, but in the 35% of the stores that I'm not in distribution, that's 0. So this is a more accurate sales per SKU. So in that you can see kind of just intuitively it fits right in between item 2 and 3 is my weighted average velocity for that item. And again, I would refer you to some of the new business metric webinars where we talk about distribution analytics in more detail. SKU optimization curves. So people love to do these optimization curves and where you say, hey, I can chop 50% of my items and only lose 20% of my sales. Well, those curves are wrong. When I have bad curves, I have awful analysis, and this is number 8. So the population of products you're looking at is wrong if you use those. By construction, you've developed a curve that can't go negative, which is wrong. Sales, if you add too much, you can see sales go down, and I've seen it. And it doesn't seem intuitive to me, and I had to see it to believe it, and I saw it, you know, I see it consistently. Big thing is not adjusted for distribution, which I'll talk about when I show the example. And then there's just, you know, again, why do people do it? Just we in the industry, and I think people in business in general just have this mindless obsession with the 80-20 Pareto condition. Ooh, how efficient. If I can get rid of 20% of, you know, 50% of the items and only lose 20% of the sales. So this is the way you see these curves built. So by construction, I've said I have 100% of my items. So the way it's being done is I'm rank ordering by total sales, all the items, and then I give a cumulative sales as a percent of the total. So by definition, I can't get more than 100%, and by definition, I end at 100%. So when I say not adjusted for distribution, I could have items here that don't make the cutoff that are only in 10% of the stores. So they get hammered because I don't have, in this method, any way to adjust for distribution. It's inherently biased toward large manufacturers. So they love it and there's no incentive to change. This is the way they get rid of all the small guys. So just so you know what techniques are being used, this is one of the most prominent. Well, and actually the right way to do this, if I look at ice cream, this is a live example of ice cream. So the total population here on the left side should be all products that could potentially be brought in. And that also would include all the products in the market that they don't carry. Or I can look at it on doors. So this is the different, as I go to the x-axis, number of ice cream doors. And the y-axis is the units per store. So you can see that I actually hit the peak sales. That's very, very hard to read, but that's 14 doors, and I've pretty much peaked on my sales. Then it starts going down. So I actually have less sales with 19 doors than 14 doors. It's like, screw it. I'm tired. I've gone through 14 doors. I'm not going to look for my product. I'm turning around and going to the next aisle. I mean, that seems to be, the behavior that's going on. There's just so much selection, so much there that the sales actually would go down. So that's actually the right way to do it. And so this is then, does adjust for the differences in distribution, because each store is, by definition, all the items are in being carried. Here's one, it's not awful, because leakage trees are awful only because of the way they're used, but they're potentially a very powerful analysis, but almost uniformly, they're just a complete waste of time because of the way they're being used. So what do I mean by that? So first of all, there tends to be, not always, but tends to be a skew toward conversion versus this concept I'll call slippage. So remember what we're trying to do. We're saying of the people that buy the category and shop my store, where do they go if they're not buying it in my store? Well, I can have leakage, which means they buy in my store at least once, but they also spend elsewhere, and slippage, which is usually more important, where they don't even buy, I don't even get them once. They slipped right through my hands and went somewhere else. The biggest issue that I see is no relative loss is provided. So yeah, here's big news. Most retailers leak most volume to Walmart. Yeah, that really helps. The big issue is how much do you expect to lose to Walmart based on fair share? And then also, nobody really says, so what? Okay, so let's even say I put the relative sales loss. I expected to lose, let's say, 35% of my sales to Walmart. I actually lost 40. So what? Can I bring other data to bear to help me understand what I should do? So here's something pulled from Category Management Association. So they're even, kind of buying into the awful analysis. So they kind of take you through the leakage tree. Here's what's leaked, meaning they converted them, but they don't talk anything about slippage. Now in this instance, this is the exception versus the rule. Leakage is a bigger factor than slippage. That almost is never the case. And so here's all the various amounts of volume that they lose to the various retailers. Well, here's the right way that you should do that. So I've masked up the data, but this is live data. Here's Earth, a very big national retailer. Might we be able to infer who that would be? This green line is what would be expected based on fair share. So of all the dollars not captured at that particular retailer, here's what they would expect to lose. But both from a leakage and a slippage perspective, much higher than expectation. But we can see slippage right here. It says 52%, meaning of the volume that I wasn't able to convert, half of it was lost to this Earth retailer, and I expected only to lose about 35%. If I also look, I can really simplify my life and my analysis. Saturn, I don't have an issue. Both are below expectation, as is Pluto, as is Venus, as is Mercury, as is all these other guys. Only one I really need to care about because it's materially high, and then I've isolated Jupiter on leakage. But I still haven't answered a big question, which is, so what? Okay, now I know that. Well, here's the so what. Now I can, do my sleuthing here. So if I have a slippage problem, it is most likely an everyday pricing, I'm not competitive, or a distribution issue. I either don't carry a major brand or a major sub-brand or a particular product group. And so I'm just losing those people overall. If it's a leakage problem, it means I've gotten them. So there's some level of satisfaction. They do want to buy, but usually promotion is very good at picking off those incremental promotions. So maybe I'm not being competitive promotionally, or maybe there's just an innovation and isolated. So it's somewhat related to distribution, but maybe there's kind of a new product launch that the consumer wanted to try in another retailer that I'm not offering. So it's distribution related, but it really is isolating on new products. So that's the so what. So we bring this leakage approach, which is potentially very powerful, and then give us the ability to isolate our search and focus on the drivers that would matter, that align with a particular business issue that we identify from that analysis. And then we go to number 10, consumer decision trees. And here's why it's bad. I mean, it is not consistent by vendor. I mean, somehow it's just mysterious. I can't understand how, but mysteriously, the results seem to always align with the strengths of the company presenting the decision tree. I can't, for the life of me, understand. It's very, very unusual. And it's a black box approach. I mean, you really don't know where these numbers are coming from, how they derive them. Usually, I mean, what you do know is if it's a top tier manufacturer, they're spending well into the six figures to get that data. And usually, and it's called a rigid tree structure, which means they impose this attribute is always more important than attribute 2, which is always more important than attribute 3, and it's just in market not like that at all. And really, at this point, we don't have a method to corroborate results. Who's to say one's more important than the other? Certainly, the in-market results haven't been that stellar. And again, I go back to the fact that the industry is, at a historical lows, and major manufacturers that are spending all this money aren't the ones, deriving the benefits. I mean, here's something that's about 10 years old, and this really set the light bulb. So these companies, the top 3 aren't really even in the business anymore. They've kind of sold or been absorbed by others. So I'm not really revealing anything here, but I was supporting Hawaiian Tropic that at the time was a standalone company, and I helped them derive a decision tree, which I will tell you how we get to that. But as category captain, we were given the trees from all the other vendors, and you can see how they're all different. So that, I mean, if there's any science to it, they all have to converge to something relatively consistent. And so Shearing Plow that had the top brand, Coppertone, mysteriously, brand was most important. Playtex that had a strategy of offering the same product in many different types of sport and kids and faces and baby, etc. Mysteriously, type was the most important, but they're the number 2 brand, so brand has to be somewhat important. So you get all these kind of attributes, and basically using a scan-based methodology corroborated with consumer survey, what I came up with was SPF was most important, branded versus private label, not specific brands, but a branded overall, and then a form innovation. And I'm going to tell you why those were correct. How you know that they're correct is the attributes need to be able to be differentiated. So for example, there is no difference, or at this point there was no difference in sales productivity by brand. They all sold at about the same velocity. So obviously specific brands weren't important. But what you also saw that was branded productivity was much higher than private label, and survey data also showed huge perceived efficacy differences between brand and private label. Brand fared much better. Form innovation, we saw no difference in lotion versus gel, etc., but we saw when new forms were introduced, that tended to generate incremental sales and grew the category. And then SPF, I mean, the category right after that grew quite a bit by all these launches at very high SPF, 70, 85, and I think there's even a couple hundreds out there. So the scan-based methodology was validated by looking at these types of metrics. Can we see it in market? And this methodology, I can assure you, ain't 6 figures. In fact, it's usually lower than, say, 30 grand. So that might be the way to go, is if you have something that's visible and has the ability to predict the future. So before I turn it over to Dustin, just want a few announcements. Last webinar, I talked about the nutritionals tracker, where we're quarterly going out with a survey to track consumer purchasing behavior by brand, by outlet, and gives us visibility to all those non-tracked channels like specialty outlets and online. And so we're doing vitamins and sports nutrition, and we're closing that on September 5th. So if you're in those industries, you'll want to try and sign up, because it's we're more than halfway to filling those up. It's limited to 5 per sector. And then also, again, to reiterate, the next annual food and beverage study is Wednesday, September 13th, and I've gotten the date, just got the data back. We also are comparing it to UK, where online is much more highly developed, and so some really interesting insights in how UK differs than US and has implications on how that we would expect online to progress in grocery. So with that, again, thanks for attending, and tossing it back to Dustin.